Welcome to Fear and Greed Summer Investing Series, brought to you by Vanta, specialists in compliance-led growth. I'm Sean Aylmer. With so much attention on the global tech giants, how should investors view our local tech sector? It's home to some very solid performers like WiseTech Global, Xero, NextDC, as well as plenty you may not have heard of. As always, this is general information only, and you should seek independent advice before making investment decisions. Shaun Weick is a senior investment analyst at Wilson Asset Management. Shaun, welcome to Fear and Greed.
Thanks, Sean. Great to be here.
Well, the tech space, I reckon, tech and healthcare are the two areas which I think are the most fascinating because you go down rabbit holes and you can make a mozza or lose a mozza, all within about a week. Let's talk about the big guys in sort of the Xeros, the REAs, the WiseTech Global. They've done, very well in the last 12 months. What's the outlook for the bigger guys?
Yeah, as you mentioned, the performance of the technology sector has been phenomenal in 2024. The index is up 58% year to date versus the All Ords up 17%. So yeah, the outperformance has been dramatic. In our view, it's been a function, obviously, of a declining interest rate environment in the US and globally, but also we think, a lack of earnings growth domestically, with elevated interest rates and sticky inflation weighing on demand here. So yeah, we think the outlook into FY25 is a bit tricky, and we have seen a decline in the sector over the past recent period. Since the Fed began cutting rates earlier this year, the US 10-year yield has actually risen 80 basis points, and it's now sitting around 4.4%, which, appears to reflect the bond market's concerns over inflation reaccelerating due to, I guess what would be termed a Fed policy error. And I suppose also the potential impact of tariffs, from the Trump government. So, rising yields are clearly a headwind to valuations, but, the US curve is still pricing in 3 cuts into 2025. So I think the other factor to consider for the tech sector into 2025 is really, China and your views around, the stimulus that they may put in the market. And, if we do see an improvement in commodity prices, you're likely to see fund managers rotate out of these, high-flying, high-valuation, technology stocks into, beaten up cyclicals and commodities. So there's a few things to consider, we think, at the moment.
Okay, so are there any particular stocks that you like in that tech sector? In your list, which ones do you like most?
Yeah, so I guess our base case is that as rates stabilise, investors will refocus on earnings growth, and we think the tech sector will continue to lead the charge from that perspective. So, the stocks we like within the technology space, so Life360. The core subscription businesses continue to grow very strongly, and 2025 does represent what we believe is an inflection point for the business with their nascent advertising business. We think Iris looks, cheap and is catalyst rich. Management have come out, recently and reconfirmed that they're going to deliver the top end of their calendar year 24 guidance. And, we think into 2025, you're likely to see, continued significant cost out, asset sales, and, a refocus on how they can reinvigorate the top line. And the final one I'd say is the much publicized DigiCo IPO, which has attracted a lot of press recently. That's fallen 14% since listing and now trades on, less than half a valuation of its listed peer NextDC. We think AI will remain a strong tailwind into 2025, which underpins data center demand. And, you're likely to see that falling rate environment benefit valuations as well. So we actually think, that one looks good buying here.
Well, those three that you mentioned, it's interesting. They're all from very different spheres of the economy. And so tech stocks are an interesting bunch because they are technology, but they're totally, or they're all over the shop in terms of what they're actually doing, Life360 is a long way from Iris.
Yeah, no, that's dead right. And then, you look at, their larger cap peers, you've got obviously the classified plays, REA, Car Sales, Seek, and then within that, obviously they've got different underlying exposures. We like REA. We think, the domestic property market will benefit from interest rate cuts at some point. Car Sales, I think the US business, they've done an amazing job there. And there's the playbook from Australia, it mirrors, 5 to 6 years ago. So we still think there's a lot of upside in car sales in the US as an example too.
Fantastic. Shaun, thank you for joining me this morning.
Thanks, Sean. Appreciate it.
That was Shaun Weick, Senior Investment Analyst at Wilson Asset Management. Remember to get your own independent advice before making decisions. This is Fear and Greed Summer Investing Series brought to you by Vanta. Vanta automates compliance for frameworks like ISO 27001, SOC 2, CPS 234 and Essential 8, saving time and money while building trust. Join over 8,000 companies like Atlassian, Dovetail and FireAnt managing real-time risk. Get $1,000 off at vanta.com/fear and greed. I'm Sean Aylmer. Enjoy your day.